Hi, everybody. I'm Austin at Homeowners Financial, and it's been a while since I did a borrower class, but I was posed with a question from a client this week that we'd gotten pre-approved, held off on the market, and we're thinking about getting back, but it's kind of still bananas. And he's like, Austin, I'm just really trying to consider, where do I put my money? What is a good investment? And I was like, Bij, that's a really good idea. And for me personally, I believe in home ownership just in my gut for the stability, the community that it makes, knowing that you can have a bit more control, a bit more space, and that it is one of the best ways to create wealth in America. That has been my belief system. But what does the data look like in the past 10 years? So I went data crazy. Now, I am not super amazing at PowerPoint. So look, this is not some crazy produced production. This is me on a Saturday trying to get this data out because I think it's important for everybody. So I'm going to share a PowerPoint I made, and I'm going to go over some points and facts, share where I got the research, the analytics from, and let's make your decision. Because hey, in the end, if you don't like the house and you're not comfortable with payment, don't buy it. Doesn't matter, right? All right, so here we go. I'm going to get this started from the beginning. Boom, 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 boom. Sharing screens on Zoom. Gonna be amazing. There we go. All right, so where do I invest, right? We're talking about a down payment or else we're going to put it in the market? Because the question was, with prices increasing, rates increasing, the stock market dropping, right? Like it's an even deeper question. It's different now in June 2022 than it has been last month, past years, because hey, things are always changing. So you can you continue to save money to buy? And if not, where do you put your money? So what have the housing and stock markets done for the past 10 years on average? So look, I'm going to take average data because you can make your own graphs, but we got to talk from an average standpoint. So the California Association of Realtors has this great website. Here's the source for you. It's looked up for the Southern California region. Now, yes, Southern California region, that is a lot broader than the 805 where I live. But again, we have to take basic data. So I looked at the median sales price and I looked up the amount increase. So this is the median sales price that was recorded for these dates. And this is the amount of increase between the previous year. So let's look at the total average. Well, on average, yes, housing goes up and down, but on average, it increased 11.3%. Now, if we exclude what we were like, oh my gosh, 2021, it's just bananas. We exclude that, you're still at 9.7%, right? So let's take those numbers. Now let's look at median rent over the past couple of years. Again, median rent. I don't know anywhere in the 805 where you can get a really good place for 2,300 compared to something that you only paid 1,200 for a while ago, right? It's increasing. So here's the amount of increase. Now, not as drastic as maybe it feels like. Again, these are averages. And this is again from California Association of Realtors. So then if we're paying rent though, you're paying somebody else's mortgage, right? And you're subject to unstable housing costs and you're lacking this long-term equity build. Again, that's going back to my beliefs of home ownership and stability. So where are you putting this money? Right? And if you're not able to itemize deductions, especially in California, you're paying more in state and federal income taxes. So then a question number 2 is, well, what's consistently a stable investment for the long term? Like where else do we put it? And you can do whatever you want with your money. But I'm going to look at the S&P 500 because the S&P, the Standard & Poor's 500 index is really like, think of it as an average, right? I mean, it is literally an index comprised of about 500 US traded companies. Purpose of this is to, just like all stock market indices, we're going to take an average of the barometer's American market, right? So just a big fat average, just think of it that way. So here's the historical data. Again, dates, S&P, you can look this up on Google Finance, totally open to everybody. So if you look at the total averages, the S&P has increased 12.92. And if we take out what we thought was so crazy in these bigger runs, 11.28. So again, very competitive with housing increases. And of course, Warren Buffett says you can't beat the S&P, that it's mostly consistent. So that's why we're looking at it. Most people don't invest in that. Yay, go crypto. So again, looking back at these averages, we got to make sure that we're looking at it consistently over time versus the in the middle. So I wanted to bring that back up as, again, a resource, so we bring that together. So what do we do with, what is a solid plan? Well, again, if you like the house and you're comfortable with the payment, I think you buy it. Here's why. America's housing supply is going to take a while to catch up. We know that prices have been increasing because everyone wants to buy, right? There's over 100 million eligible new home buyers in America, people that want to buy new property or something else. And supply-wise, baby boomers own the majority of property in America. In the last decade, we have built less than 20 million new homes. So 20 million new homes to feed over 100 million. it's going to take a while, right? And we're not going to go into balance because there's still a labor shortage. A lot of people who did the Great Recession, supply chain issues. I'm so tired of saying that. Local permit process. It took 13 months for me and Kai to get permits just to build a garage, not even living space, right? And then low historical rates mean less people are enticed to move, right? That's not going to increase the supply because the people can keep their payments. That's why things crashed, because people couldn't make their payments. So then what do, right? So we establish a budget, we stick to a plan, and we reinvest the difference, right? Here's where we start to get to the secret sauce. So if you bought it based on the median sales price in California, how much would you have gained, right? So if we invested in a house and we put $31,600 or $63,200, which is that 10% or 20% delta of the median sales price, and we rolled it forward based on the increases, we would have $87,000 built up in our equity or $150,000 built up in equity. Well, what if we did that same money and just let it ride in the S&P, right? We just let it go the entire time. Well, we'd have more technically. We'd have 113,000 with our 10% down investment, and we'd have 204,000 with our 20% down investment. But we have capital gains no matter what. On a primary residence, you can deduct $250,000 per person, maximum of 500 if it's been your primary residence for 2 out of the past 5 years, okay? So we get that money tax-free. Here we don't. The tax at the federal level is at least 15%. California on average is 10. It can be a lot more. So this is a lot cheaper than what it can be for a lot of people. So if we take that cheaper outcome, hey, we've got $84,000 or $153,000, starting to look more even, starting to look like, well, house and the S&P, it's pretty much the same, right? But wait a second, there's more, because if the average California tax refund is $6,000, right? Taking somebody that's got an average income that once you flip it into the itemized deduction, a lot of people get more. But if we just say overall, you're getting $6,000 back from home ownership, what does that mean if you take that money and reinvest it? So we started with the $6,000 the year after we bought a house, right? And then we added the S&P average. What would we gain on that? Well, then we got another 6,000 from the other tax refund, and then we had the gain from the previous years, and then we invested that together at the S&P average. Again, looking back, you can see the S&P averages. I'm using the percent increase year over year over year. So this is like an actuality that if we took just the difference from our tax refund and put it in the S&P, so now we're gaining equity in our house as well as investing that delta, we'd have another $54,437,000, another 54, right? So if we did that, where we invested in our home ownership and then we reinvested our tax savings compared to just putting in the market, then what would we have? Well, we have gained $54,000 in our 10% down scenario, and the equity would have gained means 87,000 from the median sales point equity gain. So the median sales point between the buy and the sale side, right? And then what is that between the assets holdings? It's $141,000 versus just if we put it in the market, it would have been 84,000. Same thing from the 20% down perspective, we'd have 200,000 or we'd have $153,000. The percentage gain on investable estimate is way higher if we put it into a house and build equity, take the tax savings, invest it in the market versus not investing that initial down payment in order to get that. So there you go. If you found this useful, maybe we should work together. This is me. This is how my brain works. I run a team with 5 other amazing women. Our whole goal is to look at a bigger picture. I'm not just going to quote your rate and get your approval done in 5 seconds. That doesn't help you. What helps you is to have these conversations for you and your budget. My name is Austin Lamson. I work at Homeowners Financial. You're welcome to reach me anytime. Thank you so much. I appreciate it. And I hope you found this useful. To have an amazing day. All right, guys. Cheers. Bye. Nerd out.